The U.S. government currently carries an astronomical debt of $37 trillion, more than any nation in history, surpassing the entire global economic output of just 20 years prior. Yet, what most are unaware of is that there's no plan for repayment. Instead, the strategy is to erase it, not through defaults, austerity, or higher taxes, but via devaluation, deliberate, strategic, barely visible theft of purchasing power from everyone holding dollars. What's shocking is the mechanism behind this process, something many believe is entirely separate from government control: gold and crypto. Witness as the United States orchestrates its most sophisticated debt elimination campaign to date. A parallel financial infrastructure is being constructed, with reserves in Bitcoin and gold amassed in anticipation of future revaluation at multiples of today's prices. These revaluations will serve to temporarily balance an otherwise unpayable debt. But there's a terrifying consequence to this process. As the government hikes the value of gold and crypto, the dollar simultaneously plunges in worth. Every dollar you possess diminishes in real purchasing power. Your bonds potentially become worthless, and your savings, meant to provide security, may simply vanish in real terms. This isn't a distant threat. It's happening now, and most remain oblivious until it's too late. In the following explanation, I'll reveal the precise mechanics of this debt devaluation, illustrating the historical precedents from the past. I will detail how current policies, executive orders, and asset accumulation point toward a timeline that's unfolding rapidly, with events set in motion that leave no room for reversal. The key is understanding that this isn't a distant future scenario. It's happening today. Most people don't understand that unlike household debt, government debt isn't rooted in real assets or income. When you owe money, you pay it back with actual value, earning more hours or liquidating assets. But governments wield an extraordinary power. They control the currency itself. This control allows them to modify the rules of the game, redefining what a dollar is worth, revalue their assets, and make debt disappear without ever making a payment. This process is known as a monetary reset, and it's a tactic repeatedly employed throughout history. Take, for instance, the year 1933. The U.S. was deep in debt from the aftermath of World War I and the Great Depression. With the debt-to-GDP ratio climbing past 40% and the economy collapsing, President Franklin Roosevelt took radical action. He revalued gold overnight by nearly 70%. At that time, gold was officially pegged at $20.67 per ounce, a rate set since the late 1800s. The government owned most of the nation's gold, but it was valued far less than what it could command after Roosevelt's decree. Overnight, the government confiscated gold from American citizens, paying them a mere $20.67 per ounce, well below its market value. Then Roosevelt raised the official price to $35 per ounce, revaluing gold by 69% in a single stroke. This revaluation increased the wealth of government-held gold reserves, transforming billions in assets into trillions almost instantly. Simultaneously, the dollar's value was devalued, meaning existing debt denominated in dollars became a smaller fraction of the economy's total, effectively reducing the real debt burden. Within 5 years, this maneuver shrank the debt-to-GDP ratio significantly, transferring wealth away from dollar holders and into governmental assets. By revaluing gold, they erased a substantial portion of debt without paying a dime. This historical precedent shows the significant power of revaluation, understanding that similar strategies are being employed today, right now. Currently, the U.S. owes an unprecedented $37 trillion, with interest payments alone exceeding $1 trillion annually. The debt-to-GDP ratio stands at approximately 132%, higher than at any time since World War II, and rising. Traditional methods like taxing, cutting spending, or growing the economy cannot bridge this gap. The only plausible solution remains devaluation through asset revaluation, raising the worth of reserves in gold and crypto assets to inflate their balance sheets and diminish the real value of debt. Presently, the government is quietly executing such a plan. In January last year, President Trump signed an executive order establishing a strategic Bitcoin reserve, directing the Treasury to acquire and hold Bitcoin as a vital national asset. similar to the Strategic Petroleum Reserve but for digital currency. Announced publicly as a move to position America as a leader in digital assets, the real goal is strategic accumulation, seizing Bitcoin through criminal investigations, accepting it as penalties, and acquiring more quietly, with plans to revalue this reserve at a future date. The plan involves acquiring 1 million Bitcoin over several years, not by public market purchases, but through strategic seizures and negotiations, minimizing market impact. Once accumulated, the government intends to declare that Bitcoin holds a new, strategic value, potentially $1 million per coin, instantly creating hundreds of billions or even trillions of new balance sheet value out of thin air. When they revalue Bitcoin upward, the market will follow, but in the process, the dollar's worth will plummet. As Bitcoin's value skyrockets, the dollar's purchasing power diminishes. Similarly, the government controls gold reserves, officially holding over 8,000 tons, valued at less than $1 trillion, significantly undervalued relative to current market prices. If they revalue gold to $20,000 per ounce, the worth of these reserves suddenly leaps into the trillions, creating immense new balance sheet capacity, all based on the revaluation tactics reminiscent of 1933. This coordinated asset revaluation, gold, Bitcoin, and potentially other hard assets, will drive the dollar into a steep decline. The process will elevate gold prices to new heights, with revalued gold and Bitcoin assets magnifying the government's balance sheet, allowing them to technically offset, or even erase, a substantial part of the debt. Meanwhile, the dollar's value will be crushed, leading to hyperinflation. Prices for essentials like food, energy, and housing will soar, wholly wiping out the savings, pensions, and purchasing power of ordinary Americans. Historically, this pattern repeats itself in numerous countries: Germany, Argentina, Zimbabwe, Venezuela. Each resorted to currency devaluation to escape debt, only to wipe out middle-class wealth and plunge their economies into chaos. The U.S. is following the same script, but with a veneer of sophistication, rebranding devaluation as strategic reserve revaluation, gold-backed dollars, and digital asset accumulation. The international community is also preparing. China, Russia, India, and the BRICS nations are stockpiling gold and working on alternative payment systems, gearing up for the moment when the dollar falters. As these countries prepare their own balance sheet revaluations, a global reset is imminent. The timeline hints at a coming upheaval, beginning in 2025 with quiet asset accumulation, escalating in 2026 into a debt crisis, culminating in 2027 with official revaluations and a collapsing dollar, followed by a phase of severe inflation and social upheaval. Those who position early, buying physical gold, Bitcoin, and productive assets, will survive, while latecomers will endure devastating losses. This strategy is no accident. It's deliberate, it's historical, and the writing is on the wall. The question is, will you be prepared? Act now, sell off dollar-denominated assets, acquire hard assets like gold and Bitcoin, reduce cash holdings, diversify internationally, and build skills to thrive beyond this economic reset. The only choices visible are to adapt or be swept aside. This isn't hyperbole, it's the unavoidable outcome of a debt-driven, manipulated financial system. The window to act is closing. The future belongs to those who recognize the signs and prepare accordingly. For more than 5 decades, gold was pegged at $20.67 per ounce, with the dollar defined as 1/120th of an ounce of gold. This was the gold standard. Under that system, your dollar represented a direct claim on physical gold. Yet, the government's coffers were empty, incapable of settling their debts at the existing gold price. In response, President Franklin Roosevelt issued Executive Order 6102, outlawing private gold ownership. Americans had to surrender their gold for the official rate, receiving $20.67 per ounce. Most complied, trading gold for paper currency. After collecting the gold, Roosevelt revalued it overnight in 1934, setting a new official price at $35 per ounce, a 79% increase. This move vastly altered the monetary landscape. The government, which held most of the nation's gold, saw its reserves suddenly worth $6.8 billion, up from the original $4 billion. They created $2,800,000,000 in value instantly, out of thin air, simply by adjusting the gold price. But the crucial point is this. The national debt was denominated in dollars, which now held less real value relative to gold. Before this revaluation, the debt-to-GDP ratio was around 40%. After the increase in gold's value and the inflation that followed, the actual debt burden fell to 25% within 5 years. In effect, they erased 15 percentage points of debt relative to the economy, just by changing the gold's valuation and devaluing the dollar. Meanwhile, American currency holders experienced a significant loss, 40% of their purchasing power, not immediately, but gradually through the ensuing decade's inflation. Wealth was transferred from dollar holders to bankroll the debt reduction. Those who had turned in their gold at the lower rate found themselves holding devalued dollars that could not buy back the gold they had surrendered, as reclaiming it was illegal. This is not merely ancient history. It is the blueprint for what's happening today. Currently, the United States owes an astronomical $37 trillion, with a debt-to-GDP ratio of 132%, exceeding any time in history except during World War II. The annual interest alone surpasses $1,200,000,000,000, more than the defense budget or Medicare, second only to Social Security. If interest rates stay at 5%, interest payments will reach almost $1,800,000,000,000 by 2027, constituting about 6% of GDP solely on interest, not principal. This situation is fundamentally unsustainable. The authorities, Congress, the Treasury, the Federal Reserve, are well aware of it. The numbers leave no doubt. Paying back this debt through conventional means like taxes or economic growth is impossible. The debt grows faster than the economy, and interest alone gobbles up a significant share of national output. Cutting spending isn't enough, and raising taxes only slows the inevitable. The only feasible option is devaluation, a calculated, strategic reduction in the dollar's real worth. But there's a problem with mere money printing or defaulting outright. They are aware of the consequences: hyperinflation, loss of confidence, social chaos. Instead, they're poised to execute a sophisticated strategy, revaluing hard assets like gold and cryptocurrencies, to quietly and invisibly erase the debt burden, just as Roosevelt did decades ago. This isn't speculation. It's the unfolding playbook, and understanding it is crucial. Imagine the government opting not to simply print more money to cover its staggering debt, knowing full well that such an act would trigger runaway inflation, a crashing dollar, and a collapse of public confidence. Instead, they have devised a far more subtle, sophisticated strategy, one that appears legitimate and intelligent, masking the act of theft behind a veneer of policy and innovation. This is where Bitcoin and gold step into the picture. Let's examine what's unfolding today. On January 23, 2025, President Trump signed an executive order establishing a strategic reserve of Bitcoin. This directive instructs the Treasury to acquire and hold Bitcoin as a foundational asset, akin to the strategic petroleum reserves, but for digital currency. Officially, the aim is to position America as a leader in digital assets, ensuring it keeps pace with China and other nations in crypto adoption, all while safeguarding American innovation. That's the official story. But behind the scenes, the motivation runs much deeper. Currently, the U.S. government possesses roughly 210,000 Bitcoin, assets seized from criminal enterprises like Silk Road, Bitfinex, and various ransomware operations. With Bitcoin trading at approximately $100,000 each, this stash is worth about $21 billion. No small sum, yet insignificant relative to the nation's $37 trillion debt crisis. Importantly, the executive order doesn't confine the government to its existing Bitcoin holdings. It mandates the acquisition of more. A proposed bill introduced by Senator Cynthia Lummis set a target of 1 million Bitcoin over 5 years, equivalent to roughly $100 billion at current prices. However, the government's approach isn't to buy Bitcoin openly at market prices. That would cause prices to skyrocket and costs to balloon. Instead, they seek to acquire Bitcoin discreetly, through seizures during ongoing criminal investigations, accepting it as payment for fines and penalties levied against crypto firms, and potentially even mining it using government-controlled energy infrastructure. All of this is happening quietly because their secret goal isn't merely to amass Bitcoin at today's prices. It's to acquire it before they determine its revaluation, before the official adjustment that will dramatically boost its value. Now, let's understand how this revaluation might work. Currently, Bitcoin's price hovers around $100,000. Suppose, over the next 3 years, the U.S. government quietly accumulates 1 million Bitcoin at an average price of $120,000 each, totaling about $120 billion. They do so covertly, without signaling their intentions or driving up the market. By 2028, they hold this substantial reserve, and the market remains unaware of their exact holdings. Then, at the opportune moment, they announce, the United States Strategic Bitcoin Reserve is now operational. They declare that for the country's official balance sheet and strategic purposes, Bitcoin will be valued at $1 million per coin, massively above its current market price of $100,000. This sudden, tenfold valuation isn't just an accounting maneuver. It shifts the perceived worth of their Bitcoin holdings from $120 billion to a staggering $1 trillion. What does this accomplish? It effectively transforms their previously acquired Bitcoin, bought at around $120,000 per coin, into a colossal asset valued at $1 trillion on the government's books. This surge in valuation doesn't just look impressive. It creates new, immense layers of perceived wealth and financial backing. It's a calculated move to revalue their assets, devalue the dollar itself, and mask the true extent of devaluation behind what seems like legitimate policy. By simply shifting the official valuation of Bitcoin to a hypothetical $1 million per coin for reserve purposes, the U.S. government effectively sets a new baseline that ripples through the market. Because the government is the largest holder of Bitcoin, its declaration acts as a trigger, prompting the market to gradually reprice Bitcoin upward, initially to around $300,000, then to $500,000, and eventually reaching close to the declared valuation within a year. This staged revaluation ensures that the government's balance sheet calculations align seamlessly with rising asset values. Meanwhile, as Bitcoin's value ascends, the dollar's value plummets, since the two are intrinsically linked in this process. An abrupt increase in Bitcoin's supposed worth signifies a corresponding devaluation of the dollar, making it fundamentally worth less. Viewed from different angles, the upward revaluation of digital assets equates to the dollar's downward devaluation. A coin's gain is the dollar's loss. However, Bitcoin alone cannot carry the entire strategy. The U.S. employs a dual approach, leveraging both Bitcoin for the future and gold for the past. Currently, the nation possesses approximately 8,133 tons of gold, valued on paper at around $4,222 per ounce, totaling just over $11 billion, an apparent underestimation rooted in the outdated 1,973 statutory pricing. The true market value, roughly $2,800 per ounce, renders the gold reserves worth about $731 billion. When the government announces a revaluation of gold to $20,000 per ounce, an increase that makes mathematical sense, it would instantly transform the reserve's worth to over $5 trillion. This dramatic shift alone creates an extraordinary $5,200 billion in virtual balance sheet value out of assets already owned, simply by adjusting the valuation. By combining the revalued gold reserves with the revalued Bitcoin holdings, 1 million coins at $1 million per Bitcoin, the total asset appreciation underscores the government's ability to offset a significant portion of its staggering $37 trillion debt. This asset inflation not only improves the perceived strength of the balance sheet, but also subtly devalues the dollar further, as the revaluation signals a decline in the dollar's purchasing power. Once gold is formally revalued to $20,000 per ounce, market prices tend to follow suit, climbing toward that level over subsequent years. Essentially, the official policy set by the government influences market perception, prompting an increase in gold and Bitcoin prices, while simultaneously eroding the dollar's value, culminating in a profound reset of the monetary landscape. When the world's leading gold holder declares gold worth $20,000 an ounce, backed by policy, the market begins to reprice accordingly. Gold won't leap to 20,000 overnight, but over upcoming years, it could climb from 5,000 to 8,000, then 12,000, gradually reaching that target. Meanwhile, as gold ascends to $20,000, Bitcoin's value may surge from $100,000 to $1,000,000. What happens to the dollar in this scenario? It's being annihilated. Since gold was around $2,800, a rise to 20,000 signifies an 85% loss in the dollar's value relative to gold. Simultaneously, if Bitcoin climbs from 100,000 to 1,000,000, that's a 90% devaluation of the dollar against Bitcoin. Most Americans don't think in terms of gold or Bitcoin. They focus on groceries and rent. But soon, those prices will explode. As the dollar loses between 85 and 90% of its value against tangible assets, its purchasing power drops by 50 to 70% across the board, impacting everything: food, energy, housing. To grasp what this entails in real-world terms, consider this. With $100,000 in savings today, you might feel stable, but not wealthy. If the government revalues gold to $20,000 and Bitcoin to 1,000,000, and inflation persists at a 20% annual rate, truthfully, much higher than the official figures, your costs for essentials will double or even triple. Gas and food prices will soar, and rent could spike by 60%. Those same $100,000 will then buy only about $35,000 worth of goods compared to 3 years prior, wiping out 65% of your purchasing power. Meanwhile, the national debt remains nominal at $37 trillion, but in real terms, adjusted for the inflation they've engineered, it shrinks to around 13 trillion. This effectively erases about 24 trillion of debt, not by repayment, but through devaluation. The government has siphoned this wealth away from creditors, savers, and dollar holders, reducing its debt burden at their expense. This strategy is not hypothetical, it's already underway. The evidence is clear. In December of 2024, Senator Cynthia Lummis introduced the Bitcoin Act, aiming for the U.S. to acquire 1 million Bitcoin over 5 years, holding them as a strategic reserve for at least 2 decades. It's bipartisan, with support from both sides of the aisle, because both parties recognize that debt is unpayable and that devaluation is the inevitable route. In January 2025, President Trump signed an executive order to establish this strategic Bitcoin reserve. It grants the Treasury authority to buy and hold Bitcoin, urging agencies to develop policies supporting digital assets and framing Bitcoin as a matter of national security. This isn't idle talk. It's action, hastily moving forward without waiting for Congress. On the gold front, whispers of returning to a gold-backed currency have increased, though not a full gold standard, but a partial backing. The idea is to justify revaluing assets, reset the currency, and devalue the dollar as a secret policy, all while publicly promoting stability and strength. The message is clear: financial upheaval is imminent. The stage is set, and the pieces are falling into place for a significant devaluation. Preparing now could make the difference between surviving the coming storm or being caught unawares. Some advocate for backing the dollar with a percentage of gold reserves, sounding conservative, even sound money. But in truth, it's a strategic setup for revaluation. The dollar cannot be genuinely backed by gold at just $2,800 an ounce. There isn't enough gold. With a money supply of $21 trillion and gold reserves totaling only about $71 billion at current prices, the gold backing is roughly 3.5%. That's far below what's credible. Claiming full backing with such a fraction is simply dishonest. However, if gold is revalued to $20,000 per ounce, suddenly those reserves swell to over $5 trillion, covering a quarter of the M2 money supply. At this point, the dollar can be presented as truly backed by gold. Marketed as a return to sound money, it appeals to those seeking fiscal responsibility. But what's really happening is a 7-fold increase in gold's value, which drastically erodes the dollar's purchasing power by around 85%. This is a form of theft masked as responsible policy. On the international stage, the scenario is no different. The United States relies on other countries to align with this revaluation. The BRICS nations, Brazil, Russia, India, China, and South Africa, have long discussed establishing a gold-backed currency to counteract dollar dominance. They're tired of U.S. money printing fueling inflation abroad. These nations have been amassing vast quantities of gold. China alone holds around 2,300 tons officially, with estimates reaching 4,000 to 6,000 tons unofficially. Russia's holdings are over 2,000 tons. India is actively acquiring more. They're preparing for a monumental shift, a monetary reset, anticipating the collapse of fiat currencies. When the U.S. officially revalues gold to $20,000, it won't be a sole national move. It will ripple across the world because gold's market is global. If China values gold at $18,000, Russia at $22,000, and the U.S. at $20,000, the international price will hover within that range. This collective revaluation will simultaneously devalue existing debts everywhere. Ultimately, every government faces the same problem: unpayable debt. Their collective solution? Devalue hard assets through revaluation. The U.S. is positioning for this event around 2026 or 2027. The timeline unfolds as follows. In 2025, the accumulation phase begins with the silent collecting of Bitcoin through seizures and strategic purchases, avoiding public recognition. Gold reserves remain static, but narrative efforts focus on promoting gold backing and sound money, setting the stage for what's to come. By 2026, the debt ceiling debates intensify. The threat of default or government shutdown becomes imminent, and bond markets, that have been signaling distress, start to spike in yields. Confidence wanes. This crisis serves as the justification for extraordinary measures, allowing the government to implement policies that would be impossible under normal conditions. The impending crisis serves as the perfect pretext. By 2027, the phase of revaluation begins. The government reveals the official launch of its strategic Bitcoin reserve, boasting ownership of 1 million Bitcoin valued arbitrarily at $1 million each on the balance sheet. Simultaneously, a reintroduction of partial gold backing is announced. The dollar will be backed by gold again, with the metal revalued to $20,000 per ounce for reserve purposes. Marketed as a move to stabilize the currency, restore confidence, and reaffirm America's economic leadership, this narrative persuades the public because it sounds strong, responsible, and like the opposite of money printing. But beneath this veneer, what is truly unfolding? Over the span of 12 to 18 months, Bitcoin's price surges from $100,000 to $1 million, while gold soars from $2,800 to $20,000 per ounce. Throughout this period, the dollar's purchasing power plummets by approximately 70%. Inflation ignites, initially rising from 10% annually to 50%, with food and energy costs tripling and quadrupling respectively. Housing prices double nominally but decline in real terms as affordability vanishes. The economy stagnates amidst rampant inflation, low growth, and unemployment climbing to 8 or 10%. The middle class is decimated. Yet, despite this chaos, the massive debt, initially $37 trillion, becomes effectively erased. Its nominal value remains, but in real terms, it shrinks to around $12 trillion. The government survives, creditors are wiped out, savers are victimized, and all of this is achieved legally, justified as necessary for America's financial stability. The winners are clear: the U.S. government, which eliminates a staggering $25 trillion of debt in real terms without default; politicians, who sidestep the pain of tax hikes and spending cuts; and the Federal Reserve, maintaining control over monetary policy. Early Bitcoin holders, those who bought at $30,000 and see it rise to $1 million, reap enormous gains. Gold investors, who acquired at $800 an ounce and witness it climb to $20,000, also profit, though they must endure intense volatility. Other nations follow suit. China, Russia, and India, with their own gold reserves, revalue their assets, erasing debts using the same mechanisms. Wealthy individuals with real estate, stocks, and businesses see their assets inflate in nominal terms, preserving their wealth through the transition. Meanwhile, the middle class bears the brunt. Those with savings in dollars, retirees on fixed incomes, and bondholders are crushed as they are repaid in devalued currency, losing roughly 70% of their holdings in real value. Pension funds holding massive amounts of government bonds become worthless in real terms, and workers see their wages stagnate or fall by nearly half, while living costs spiral. Renters face rising rents unaccompanied by wage increases, pushing many into poverty or homelessness. Small businesses, unable to raise prices rapidly to keep up with costs, fail in droves. The cherished American dream dies a quiet death, suffocated by the currency's destruction. This is not hyperbole. It's a stark mathematical reality rooted in history. Let me illustrate with parallels from the past. In the 1920s, Germany faced a crisis when it couldn't pay its war reparations, prompting them to print money. The result was hyperinflation, which decimated the middle class, yet the government's debt was wiped out. Similarly, Argentina repeatedly devalued its peso during the 1980s, 90s, and early 2000s, erasing debt while savings vanished into thin air. Zimbabwe in the 2000s printed excessive money, turning the dollar into worthless paper, with wheelbarrows of cash needed for bread, yet their debt disappeared. Venezuela's hyperinflation of the 2010s eliminated its debt burden, though at the cost of economic collapse. This pattern is universal. Governments push currency into devaluation, creditors and savers lose everything, while the government survives. Today, the United States is executing the same script, just with more sophisticated branding. Instead of openly printing money, they call it strategic reserve revaluation. No longer labeled as currency debasement, it's gold-backed dollar restoration. What they call theft, they label necessary policy to preserve America's financial stability. But the outcome remains unchanged. People like you and me end up paying the price. It's imperative you act now, before this revaluation occurs, because once it happens, it's too late. First, divest from dollar-denominated assets. Bonds are dead. Whether government bonds or corporate, they'll lose about 70% of their value in real terms. Sell them immediately. Holding dollars in savings accounts, checking accounts, or money markets is also a losing game. They're all set to be devalued. Limit your cash, keeping only what's necessary for 3 months' expenses. Second, shift into hard assets. Physical gold, coins or bars stored securely, is the ultimate store of value proven over 5,000 years. It will shield your wealth during the reset. If you understand how to hold Bitcoin securely, consider it as digital gold, more volatile but with potential for enormous upside. The U.S. government is poised to revalue Bitcoin to $1 million per coin, so acquiring it before that move is essential. Third, invest in productive real estate, farmland, or income-generating properties in strong markets, excluding vacation homes or speculative ventures. Commodities like energy, agriculture, and industrial metals will also rise with inflation, especially through dedicated funds or direct ownership. Finally, get out of debt. This may seem counterintuitive. After all, devaluing dollars means repaying with cheaper currency, theoretically advantageous. But since your income is also denominated in dollars, it won't keep pace with inflation. Wages stagnate while your debts remain constant, making debt a trap, especially high-interest or variable-rate loans. Paying off what you owe now can safeguard you from the worst. Remember, this process is happening right now. The historical record proves that currency devaluation, whether through hyperinflation or strategic revaluation, consistently destroys the middle class, impoverishes savers, and consolidates government power. The key is recognizing the pattern early and acting decisively. Protect your wealth, stay ahead of the reset, and don't wait until it's too late. Even as you repay debts with devalued dollars, the real value of your money diminishes, and the math simply doesn't favor individuals. Only governments can turn this scenario to their advantage. For individuals, debt becomes a trap because you cannot conjure money out of thin air. You must earn it. Yet, wages rarely keep pace with inflation, leaving many vulnerable. The best approach is to eliminate high-interest debts, credit cards, personal loans, car loans, immediately. Mortgage debts are trickier. If you have a fixed-rate mortgage at 3 or 4%, it's best to keep it, as inflation will erode its real burden. However, if you possess an adjustable-rate mortgage or a high fixed-rate loan, paying it off or refinancing makes sense. Next, diversify your holdings internationally. Resist the temptation to keep all your wealth in U.S. dollar assets. Open accounts in foreign banks, Swiss francs, Singapore dollars, Norwegian krone, currencies from countries underpinned by low debt and strong fundamentals. Invest in foreign real estate in nations that aren't devaluing their currencies, and consider foreign stocks earning revenue in non-dollar currencies. The aim is to spread wealth across multiple currencies and jurisdictions, so that when the dollar falters, your exposure is minimized. Building skills and nurturing relationships is equally vital. When currencies collapse, what truly matters is your ability to produce, what you can offer, and whom you know. Skills that generate consistent value: trades, medical expertise, agricultural knowledge, repair skills, plus connections with resource holders, land, food, tools, are your best insurance. Community resilience becomes more crucial than cash when fiat money fails, because history demonstrates that currency collapses breed social unrest. Possessing valuable skills and a strong network is your safeguard against chaos. Now, some may dismiss this as doomsday prepping or conspiracy theory, but the facts are undeniable. The U.S. debt-to-GDP ratio stands at over 132%. The annual interest on this debt exceeds $1.2 trillion. The government cannot feasibly cover this through tax hikes or spending cuts. Mathematically, the only viable option is devaluation. History confirms this pattern. In 1933, the U.S. revalued gold and devalued the dollar, and similar resets have occurred worldwide, from Argentina to Zimbabwe, all aimed at erasing unsustainable debts through currency devaluation. The question is not if, but when and how this will happen. I have shown you the how: revaluation of gold and Bitcoin, targeting between 2026 and 2027. The pieces are moving, executive orders are signed, bills are introduced, and the narrative is shifting. This is not clandestine conspiracy, it's clear policy, unfolding visibly. Further evidence lies in the actions of global central banks, which are buying gold at record rates. Over 2,000 tons in 2022 and 2023, the most since 1950. They see the writing on the wall. China is accumulating Bitcoin through state enterprises, Russia is stockpiling gold and reducing dollar reserves, and the BRICS nations are forging alternative payment systems. All are preparing for a reset, a coordinated move towards devaluation and financial overhaul. Act now. Don't wait for the full crash to unfold. Protect your wealth by reducing dollar holdings, accumulating hard assets, gold, Bitcoin, productive real estate, and diversifying internationally. Master valuable skills and forge alliances, for these will be your strongest assets when the storm arrives. This isn't mere speculation, it's the inevitable trajectory rooted in historical precedent and current policy. The window to prepare is closing. Be vigilant, adapt, and secure your future before the reset is irreversible. If this vision resonates with you, please subscribe for more insights and timely updates, so you can stay ahead of the coming changes. Nations within the BRICS alliance, Brazil, Russia, India, China, and South Africa, are actively constructing alternative financial systems, laying the groundwork for a future beyond the dollar. With intelligence agencies, economic experts, and insider knowledge guiding their moves, these governments are uniting around a shared goal: orchestrating a dollar collapse and executing a strategic monetary reset. If they are preparing in this way, why aren't you? Let me clarify the timeline again, because understanding it is crucial. In 2025, the focus is on accumulation. The United States is quietly acquiring Bitcoin, while the narrative surrounding gold intensifies. You should be doing the same. This is your prime window for building hard assets like gold and Bitcoin. Come 2026, the crisis stage begins. The debt ceiling showdown causes market upheaval. The government may invoke extraordinary measures, provoking volatility and price swings. During this period, resist panic selling. Hold on to your hard assets. Then, in 2027, the revaluation phase unfolds. Bitcoin will be revalued to $1 million per coin, and gold to $20,000 an ounce. Simultaneously, the dollar will sharply devalue, and inflation will surge. Those who position themselves in 2025 will endure, while others risk ruin. Between 2028 and 2030, the stabilization period takes hold. Prices settle. Bitcoin may reach $500,000 to $800,000, gold between $15,000 and $18,000, and the dollar will have lost substantial purchasing power. The reset concludes, leaving those with hard assets financially preserved, while dollar holders see their wealth diminish by approximately 70%. The stark reality is that this reset isn't accidental. It's a calculated policy. It's designed to wipe out debt by devaluing the currency. Default is avoided at all costs, because failure to do so would shatter the government's credibility forever. Devaluation, therefore, is the chosen strategy. It slaughters public wealth, but sustains governmental power. The creation of a strategic Bitcoin reserve isn't about innovation alone. It's about establishing an asset to facilitate revaluation. Similarly, the talk about returning to a gold-backed dollar isn't about enforcing sound money. It's about justifying a gold revaluation. Every move is setting the stage for the reset, with you potentially becoming collateral damage unless you act quickly. Here's an actionable plan. Week 1. Open an account dedicated to precious metals. Purchase at least 1 ounce of physical gold, scaling up according to your financial capacity, aiming for 10 to 20% of your net worth. Week 2. Set up a Bitcoin wallet by a starting amount, say $1,000, scaled to your risk tolerance, targeting 5 to 15% of your assets. Week 3. Review your bonds. Sell all long-term government bonds and corporate bonds unless they are very short-term, and channel the proceeds into hard assets or short-term investments. Week 4. Reassess your cash holdings. Limit them to a 3-month expense reserve and transfer excess cash into tangible assets. Over the following months, diversify internationally, open foreign bank accounts, explore overseas real estate, and consider foreign stock investments. In the 3rd month, focus on developing skills and communities that will retain value during instability. Think trades, agricultural expertise, repair knowledge, and build networks with resourceful individuals. These social and practical assets serve as insurance when fiat currencies falter. The critical message: this isn't mere speculation, it's unfolding policy. Governments across history and around the world, whether in Germany during hyperinflation, Argentina, Zimbabwe, or Venezuela, have followed this trajectory. They devalue their currencies, eliminate liabilities, and transfer wealth from savers to power. The U.S. is following suit, but with more sophisticated branding, calling it strategic reserve revaluation or partial gold backing, rather than outright theft. And the signals are undeniable. Central banks worldwide are rapidly accumulating gold and making covert moves into digital assets. BRICS nations are actively preparing, accumulating gold, and exploring alternative payment channels. This collective buildup points toward a global reset, likely around 2027. The window for action is narrow. Starting in 2025, the U.S. quietly amasses Bitcoin, sets the narrative, and prepares for the upheaval. Come 2026, the financial chaos ensues, leading to revaluation in 2027, with the dollar plunging and inflation soaring. Those who are prepared will survive, those who aren't will suffer. The bottom line: this is a planned reset, not chance. Avoid being collateral damage. Protect your wealth now with physical gold, Bitcoin, and strategic international diversification. Develop your skills, build your community, be resilient. Do it now, before the window closes and the reset becomes irreversible. Develop your skills that add tangible value and actively connect with local communities. Consider acquiring rural property or land access. They are vital components of your strategic action plan, executed step by step each week. Do not delay. The opportunity is slipping away. Now, I want to address the moral side of this situation. Some may feel this isn't fair, and you're right. What's happening isn't just unfair, it's a form of legal theft. Yet, this theft is occurring regardless of moral judgment. You can remain morally outraged and find your finances destroyed, or you can choose to become aware of the reality and position yourself accordingly. I would prefer you survive this upheaval and be able to fight another day than to cling to principles that leave you vulnerable to total loss. The government's concern isn't principles, it's survival at your expense. They will sacrifice you without remorse if it means preserving their power. The stark truth of authority is that you must adapt or face obliteration. Secure your wealth in hard assets now, precious metals, cryptocurrencies, real estate, that will hold value through the coming reset. Use that preserved wealth to rebuild and thrive in the aftermath. Alternatively, You can continue trusting the narrative, holding dollars, and believing they are looking out for you. Watch everything you've saved evaporate and remain helpless. I am certain of my choice, and I am confident that smart money is already acting. The critical question is, which side will you be on? Before this timeline transforms your perspective entirely, don't face it alone. Join the membership to receive exclusive, real-time updates tracking the reset as it unfolds, insights into policy shifts, price movements, and key indicators. I'll be revealing the evolving timeline first, helping you stay ahead. If you want to safeguard your wealth and navigate this upheaval successfully, act now. Links are below. Remember, this isn't financial advice. Do your own research. I'll be monitoring this process over the next 2 years, highlighting the signs, policies, and developments that will determine your financial fate. Recognizing these signals could mean the difference between preserving your wealth or losing everything. Share this message with everyone who has savings, retirement accounts, or trusts in the dollar. They need to understand that the 2027 reset is imminent. The U.S. government is leveraging Bitcoin and gold to wipe out $37 trillion of debt, while quietly eroding your purchasing power. The time to act is now. The choice remains yours.